Tyler, I've owned FedEx for a long time. I think today is an overreaction, but it's an overreaction to a year that up to now was up about 60 some odd percent. Stock's still up 55% year to date. I look for companies that are growing earnings faster than the average company in the S&P 500 and that are selling, if I can, for a lower multiple. Well, the average multiple of the S&P 500 now is 19 to 20 times earnings. FedEx right now is trading 12.5 times next year's earnings. Earnings growth for the S&P 500 is supposed to be 10 or 11% next year. Most analysts don't think that it's going to actually meet that in a slower GDP growth year. This stock should be growing earnings at 15% for the next 5 years. So I have superior earnings growth in the companies I favor. This is one of them. I think it's a blip now. It was from the higher cost express segment. Putting some pressure here, but this is not a broken company. It's not a broken stock, and you got a 1.8% dividend while you wait. I'm going to continue to hold, and I would add on this weakness.
Okay. Up next, General Mills, shares slipping 3% after the food products company posted a miss on the bottom line amid softer demand and pricing pressures. General Mills, like FedEx, lowering its full-year sales forecast. Michael, your take on General Mills, and by the way, the staples, which are broadly down alongside it.
Well, they are. And with the FedEx, actually, they maintained guidance for the year, but their actual sort of median number is below where the street was. So they kind of took the street a little lower, but not their number lower. General Mills, different problem, okay? Different problem. Down 22%. Ugh, I feel bad for them. 15 times earnings, that meets my pricing. But earnings growth of 4%. You know, they've got a bunch of sugary snack stuff, a lot of snack food, cereals. And I think there's even some pressure from the GLP-1 drugs, the anti-obesity drugs. People just don't eat as much on those. Also, during times when the consumer's trying to save a little bit of money and be more budget sensitive, they don't buy brand names. They have a trade down to generics and other names. I think General Mills is going to be under pressure for a while. I don't think this is going to be a place to make money anytime soon.
That's a no. Let's go to Lowe's now. Michael, shares down.
That's a no.
That's a no. No. Hold the cereal. Shares down 1% after Stifel downgraded the home improvement retailer to a hold. Last month, the company cut its full-year sales and earnings guidance. Michael, your trade, sir, on Lowe's.
Look, I've owned Lowe's for a long time. I think they perform very well. I mean, they're up 12% year to date, 12%. As a retailer, and retailers, remember, Tyler, have struggled across the board this year. I think this company has a strong balance sheet and good management. 17 times earnings at a discount to the S&P 500, just right around a 2% dividend while you wait, and 12% earnings growth. So I've got superior earnings growth at a discount price with a dividend while I wait. They're gaining in that pro share. You know, you go to the stores and it says pro parking only. They're gaining there. That's profitable. And in their rural stores, Tyler, that's their best performing DIY sector. I like this company. I like the management. It's certainly a good hold for me, and I would add where I didn't have it.
You know what I like, Michael? The lemon cake you sent. Thank you, sir. Delicious,
It is delightful.
as always.